This tutorial explains the concepts behind the Black Scholes method of valuing stock options. This is the Black Scholes Dashboard of Jim Sample. It calculates the total value of an option grant using the Black Scholes formula and allows you to revise the current assumptions to compare the results. Let's begin by reviewing the concepts on which this dashboard is based. Black Scholes is an accepted industry standard method of calculating the total current value of a stock or market traded option. The Black Scholes value of an option can be thought of as consisting of two additive parts: the intrinsic or in the money value and its time value. In the money value is easily understood as that it is the current stock price minus the strike price times the number of shares. For time value, consider an option that is a little bit out of the money or underwater, but is a ways from maturity. Is this option worthless? Would you be willing to give back an option when the current intrinsic or in the money value is zero? Of course not, since there is a significant chance that the option will be in the money at maturity. The value over and above the in the money value is called time value, because an option has a fixed exercise price that is good for a specified amount of time, during which time its value can grow. These are the factors which are involved in the calculation of time value with Black Scholes: time until expiration, volatility of the stock price, the in the money value or leverage, risk-free rate of return, and the per share dividend. Now let's review each of these factors to see how and why they affect the future value of a stock option. The first Black Scholes factor affecting time value is the time until expiration. As an option approaches expiration, its time value decreases. This is because there is less time for the option to realize its theoretical potential. Lower potential equates to lower time value. The next factor affecting time value using the Black Scholes methodology is the volatility of the company's stock price. Stock price volatility is a statistical method to provide range of possible stock prices over the option life. It is stated as the annualized standard deviation of the stock's changes in price, and it is expressed as a percentage. For example, a standard deviation of 0.3 equates to a volatility of 30%. It's important to note that there are different types of volatility: historical, the actual volatility that occurred to the underlying stock during some look-back time period; and implied, the market's estimate of future volatility derived from the option's bid-ask mid-price. This chart shows the 30-day historical and implied volatility for NDAQ stock over a 12-month period. As you can see, the two types of stock price volatility can vary significantly over this time frame. A volatile stock has a higher upside potential over time. Consequently, the greater the volatility, the higher the time value of the option. So given a large range of volatility factors to choose from, the question becomes, what value should I use? Here are some issues to take into consideration when selecting a volatility assumption for the valuation of an employee stock option. The Black Scholes methodology is used to calculate the value of different types of options and for different purposes. Therefore, the selection of a volatility assumption will vary according to type and purpose. Black Scholes calculation is used to value market-traded options. It is also used to expense employee stock options on annual financial statements, and for calculating the total value of individual stock options at the current time. The volatility assumption used in any of these situations will differ because the objective of the valuation differs. Consequently, the selection of a volatility factor for the purpose of valuing an individual stock option is an art, not a science, and it is prudent to compare a variety of sources to validate the assumption. The volatility value used to expense company stock options can be found in annual reports of publicly traded firms. This is a good place to start, but the value used in this situation is dated and serves a different purpose. The current value of an individual stock options is as of the time of valuation, so comparing the company volatility with the market volatility values found at ivolatility.com or other sources provides additional insight. For non-publicly traded firms granting options, it is advisable to use peer company comparisons. As an example of examining different sources, for the 12-month period ending 12/31/07, the NASDAQ company used a volatility of 35%. As of the end of July 2008, index market trading option volatilities varied between 65% and 75%. Using these two sources, it is reasonable to select a volatility between 35% and 75% for the purpose of valuing an individual's options at the present. In summary, the volatility assumption is a major determinant of time value, and it can vary significantly based on source and usage, so selection should be made with careful consideration. A third factor influencing time value is the extent that an option is in the money or leveraged. As the in-the-money value of an option increases, the time value decreases, because the upside leverage is less than it is when the fair market value of the stock is near the option or grant price. Time value decreasing is due to having more and more intrinsic value or in-the-money value that can be lost if the price falls, offsetting the potential gain in the money value if the price rises. Let's review the concept of stock option leverage. Stock options have leverage because the option or grant price is fixed. High leverage occurs when the stock price or fair market value is close to the grant price. For example, if the current stock price is $11 on an option of $10 and then goes up by 10% to $12.10, the in-the-money value leverage goes up by 110%, from $1 to $2.10. Conversely, low leverage occurs when the option is deep in the money. For example, if the current stock price is $100 on the same option of $10 and goes up by 10% to $110, the in-the-money value leverage goes up only by 11%, from $90 to $100. Thus, the higher the current stock price is relative to the option price, the less upside leverage or time value remains in the option. The fourth factor affecting time value of option is the risk-free rate of return. Given that an option provides the holder with the right to own the stock at a fixed price without having to purchase it, the value of the option is enhanced by the ability to use the capital that would otherwise be invested for some other investment. The risk-free rate of return represents the return on the other investment, which enhances the value of the stock option. Based on the opportunity cost savings and reinvestment, the higher the risk-free rate of return, the higher the time value of the option. As with the volatility assumption, the risk-free rate can be derived from a variety of sources, including T-bills and the company's annual report. And the final factor used in the Black Scholes formula is the per share dividend. Dividends decrease an option's time value because the holder is foregoing the dividend until the time of exercise. Should be noted, large dividends on options that are deep in the money and approaching expiration can cause the time value to go negative. Consider not including the dividend, even if the company has one, if the individual intends to exercise and sell for diversification purposes. In these cases, the dividend is not relevant and its inclusion will result in a lower time value. In summary, time value decreases as the expiration approaches. Time value decreases as the in-the-money value increases. Time value is higher for stocks with higher volatility. Time value is higher when the risk-free rate of return is higher. And time value is lower when the dividend is factored in. For more information on Black Scholes, see the white papers in the university. Jim's Black Scholes Value Dashboard calculates the time value and the Black Scholes value for each option grant using the stated assumptions from the database. The values are broken into columns for the vested and unvested time value, the vested and unvested Black Scholes value, and total time value and Black Scholes values for each grant. We can revise Jim's stock price, Black Scholes value date, volatility, dividend, and risk-free rate using the sliders or input boxes. Changes to the stock price, volatility, or risk-free rate assumptions will produce corresponding increases or decreases in revised values. For example, if we increase the volatility by 15% to 50%, the total time value increases by over $190,000. The addition of a per-share dividend will result in a decrease in time value. For example, if we reset the volatility to 35% and input a $1 dividend, the time value decrease is approximately $370,000. We can also modify the Black Scholes value date assumption to simulate a reduction in the time until expiration, such as in the case of a planned retirement. For example, if we reset the dividend to 0 and advance the Black Scholes value date 3 years, there is a reduction in time value by nearly $170,000. In conclusion, the Black Scholes Value Dashboard is a powerful tool to help one understand the concept of time value and how it can be affected by revising the input assumptions for various possible scenarios.